Today we need to talk about gold. Really, everyone needs to be talking about gold. You're lost if you aren't, because your personal finance and your future wealth and comfort and all that, it depends on gold much more than you think. The world is changing fast, more from surging inflation to geopolitical shakeups. Everything's moving fast, and much of it is moving in the wrong direction for a lot of traditional investment assets, and so gold is back in the spotlight in a pretty huge way. As of the making of this video, May 4th, 2025, gold's price has surged from a little over $2,300 per ounce a year ago to over $3,200 per ounce. That's a 40% one-year return. All the while, everyone's favorite index, the S&P 500, managed a measly 10%. Gold critics like to call that an aberration and pretend that that's what commodities do. They reach dazzling highs before they come crashing down. So why is it then that gold hasn't just outperformed the S&P 500 over the last year, but also outperformed it since the year 2000? Have a look at this amazing chart over here. Had you invested $10,000 into the S&P 500 on January 1st, 2000, you will have seen this $10,000 grow to be a little over $62,000 over the last 25 years. That's with dividends and all the extra toppings and all that reinvested. That's kind of impressive, but wait, the same investment, $10,000 still, in gold wouldn't have netted you any dividends, but through sheer price appreciation alone, it would have grown to be just over $102,000. Now, I'm no gold critic, still I just don't understand how critics can call the last 25 years an aberration. This data is accurate as of the time of the making of this video, by the way, May 4, 2025. Perhaps billionaire maverick investor Ray Dalio has a point. If you don't own gold, you know neither history nor economics. And so, as we head into what appear to be some economically historical times, most retail investors will end up on the losing end, but some might wise up and make it big, because the case for gold has never been stronger than it is today, with accelerating de-dollarization trends across the globe, monetary debasement pressures, massive central bank gold buying, a potential showdown of the physical and paper gold markets, not to mention inflation spikes, trade wars, and US sanctions. It seems like all trends, every single trend, favors gold, and in this video we'll discuss all the most important recent events in the context of the wider picture and what that means for your personal finance and investment plans. As always, past performance is not a guarantee of future results. Investing involves risks, including the possible loss of capital. The information in this video is educational, purely educational, and should not be considered personalized investment advice. Always do your own research and seek professional advice from a licensed professional before making any big investment decisions. Everyone complained about inflation in 2022, but few people seem to realize that inflation is happening all the time. And what I mean by that isn't that you end up paying a couple of percentile points more for groceries year on year, but that periods of really high inflation, like what we saw happen in 2022, aren't exactly unique or special. Look back through the 20th century and you'll find that inflation spikes tend to happen a lot, and they'll continue happening over and over again. And if you want my personal educated prediction here, they'll only become more frequent in the future. That's because inflation spikes don't just happen out of nowhere, even if your favorite politicians tell you so. Extremely high inflation is often the result of consistently poor government fiscal policy that sees central banks print more currency, making the money in your wallets worth less. We call this monetary debasement, and here in the United States, the Federal Reserve has been doing this monetary debasement at a pretty unprecedented scale. The money supply is the total amount of money, including all cash, all coins, and all balances in bank accounts, all of that in circulation. We're primarily interested in the M2 money supply because of how closely tied it is to inflation. That's because M2 money supply represents all currency, banknotes, and coins in an economy, all deposits available on demand in checking and saving accounts, as well as all non-cash assets that can be easily converted into cash. Think saving accounts, short-term deposits, and short-term securities like US Treasury bills. Now, here's a chart that should be keeping you up at night. This is the United States M2 money supply since the year 2000. This graph is so wild. And it really illustrates just how crazy this situation is. Since the year 2000, the M2 money supply in the United States has increased by nearly 370%. All the while, over the last 25 years, the United States population has increased by just 20%. So let me put this to you in some other way. In the year 2000, there was around $16,000 of money supply in the US economy per person. Today, there is roughly $68,000 or 4.25 times as much. Now, here's a question for you. Do you feel like the average American today is 4.25 times more wealthy compared to the year 2000? I think you probably said no. And it's not just us saying this, by the way. The M2 money supply may have increased by 370% since the year 2000. But we know for a fact that median household incomes increased by only 60% in comparison, while real household personal disposable incomes increased by a more modest 40%. In fact, the only thing that seems to have grown somewhat comparably to the M2 money supply is the total household debt, which saw a 280% increase since 2000. I think the question is obvious here. Where is all of this money going? The reality is it's going nowhere because it's not there. It's worth nothing. It doesn't really have any real value. The money printers may be switched on at full speed, but all this new currency entering circulation is only diluting the value of each dollar that already exists in your wallets and in your bank accounts. The reason I know this is because while the M2 money supply has grown by 370%, US real GDP has only grown by just 72%. Think about that for a second. Tell me you're not equal parts confused and utterly weirded out. The US has certainly grown richer over the last 25 years, as shown by the real GDP growth data. But for every dollar of real GDP gained in those 25 years, 5 new dollars were printed out by our government. And if you're thinking about investing in the stock market, perhaps think again, because while the S&P 500 provided investors with total returns of 520% over the last 25 years, which certainly sounds great on paper, what's a 520% return when the money supply and currency has been inflated by 370%? So after a quarter of a century, each dollar of M2 now buys about 31% more S&P 500 than it did in 1999. These are the things that no one accounts for when they are thinking about stock market investment returns. But jokes aside, this is pretty serious because since the creation of the Federal Reserve in 1913, the US dollar has lost roughly 96% of its purchasing power. Inflation spikes, like we saw happen in 2022, occur when the money supply growth becomes so great that it breaks the system we've got, so the system needs to reset. But the reality, however, is that these are not isolated incidents. The modern financial system, with its fiat currencies and monetary debasement as we know it, is nearing its end and gradually being worn down by every single day by poor fiscal decisions. Gold, on the other hand, stands resolute as a safe store of value. I'm sure you've heard people say this before about gold. It's a safe store of value. I, for one, don't blame you for side-eyeing them. I do too, because it's kind of hard to make sense of a statement like that. So allow me to contextualize that statement for you. A regular 16-ounce loaf of bread from a supermarket today costs you what? $2.50, right here. Now, a little maths tells us that's about 0.024 gold grams. Want to know how much a similar sized loaf of bread cost in ancient Rome 2,000 years ago? Well, according to the shopping list from the 1st century AD, the price of a common 1-pound loaf of bread would have been an eighth of a denarius. We're able to calculate the price of this loaf of gold since the Romans used coinage that was made from gold and silver, with each denarius containing roughly 0.292 grams of gold in the 1st century AD. In other words, a loaf of bread in ancient Rome was valued at 0.036 grams of gold, while today a similar sized loaf of bread will cost you 0.024 grams of gold. Nice. That's what we mean when we say gold is a store of value. Unlike the dollars in your wallet, you needn't worry about your gold buying less stuff over time. It clearly has not over the last 2,000 years. This isn't just limited to loaves of bread, by the way. Don't worry. A fancy toga in ancient Rome would have probably cost you about an ounce of gold, or $3,200 today, which is about how much you'd expect to pay if you were in the market for a quality business suit. Here's the deal with fiat currencies. Because paper money can be printed, this means it invariably will be. That's just how things work. The gold supply, on the other hand, is protected from the whims and fancies of political leaders and their economist henchmen. There's only so much of it here on Earth, and while world gold production certainly has increased in the 20th century, it has now flatlined. We've hit a wall, and it's actually been decreasing in recent years. Now, it seems that we won't be able to ever mine more than 3,200 tons of gold per year globally. This means that each year, the mined gold stock increases by just 1.31%. Contrast this with the M2 money supply, which since the year 2000 has grown by an average of 6.44% each year in the United States. It's really no wonder that gold holds its value while fiat currencies' value erodes over time. Gold is literally the world's oldest hard money. That's solid economic reasoning to have some gold now, before inflation or currency woes get any worse. One option today is Strategy Shares GOLY ETF. It's a fund that combines investment-grade corporate bonds with a gold overlay. It aims to give you the returns of gold plus a steady yield of about 5% when annualized. It's a pretty innovative way to hedge inflation and earn income at the same time. Monetary debasement of the dollar isn't the only factor driving gold prices sky high. Countries just don't want to hold dollars anymore, something that's been the norm for decades now. This is obviously somewhat connected to monetary debasement, since the United States 2020-2021 stimulus program involved inflationary money printing, which, despite providing relief to millions of Americans who found themselves out of work, also had the unintended side effect of devaluing the foreign reserves of many countries all across the globe. Here's a thought experiment for you to try out. Imagine you're Pakistan, like the country of Pakistan. And because no other countries really want your national currency, the Pakistani rupee, you trade in US dollars. This means the country of Pakistan needs to keep foreign US dollar reserves at hand. It then uses these reserves to buy food staples and essential medicines, for example. These reserves are also used to provide local Pakistani businesses with foreign currency, allowing them to import and pay for various goods and services. All sounds good so far, yeah? Cool. Well, in 2019, Pakistan had roughly 17.5 billion US dollars in foreign reserves. Now, because unlike the United States, Pakistan can't obviously print its own US dollars, it really can't cheat the system in the same way that the US did in the aftermath of the economic crash caused by the 2020-2021 lockdowns, forcing the country of Pakistan to just live with any fiscal decision that's made by the United States and its politicians. And so, when the United States decides to undertake what is an unprecedented stimulus program through dramatically increasing the available money supply, causing both inflation and interest rates to spike down the line, you can see how Pakistan can become squeezed. That's 17.5 billion US dollars that Pakistan uses to buy medicines and food for its people. Well, by 2025, it's lost about 25% of its value due to the US choosing to turn on the money printing machines at full speed, debasing the value of its currency. Of course, it doesn't just stop there, because despite being a poor and developing country, Pakistan also has around 130 billion US dollars in foreign debt. When the Federal Reserve raised interest rates as a result of spiking inflation, it itself caused by turning on the money printing machines, the interest on Pakistan's debt soared. No one will be interested in buying high-risk Pakistani debt at an 8% interest rate when the United States is offering 5% interest at zero risk. Okay, so I don't expect you to care very much about Pakistan. However, this situation I've just described here doesn't just affect Pakistan. It affected just about every country that holds a significant amount of US dollars as part of its foreign reserves, which just happens to be most countries in the world. One reason why I believe that gold could triumph over the US dollar is this. I think most Americans understand that having your currency be the world's reserve currency is a huge privilege, one that comes with enormous advantages. However, I don't think that most Americans seem to realize that a huge privilege comes with responsibility. You can't just inflate away your currency, even if it's to provide much needed stimulus to the national economy, when every single country in the world relies on your currency's value and its stability and their reserves of US dollars to trade and provide for their people. Countries across the globe hold around 6.5 trillion US dollars in their foreign reserves. None of these countries, none, zero, want to see these holdings devalued by 25%. Is it really any surprise that de-dollarization has accelerated since 2020? The US dollar share of global reserve currencies was already crashing, falling from a 66% share of global foreign reserves in 2016 to 58% in the last quarter of 2024. Tariffs and trade war risks are severely accelerating this. That said, there's currently no clear alternative to the US dollar, which probably explains why central banks all across the world have been stockpiling gold. In a de-dollarizing world with no clear runner-up to replace the US dollar, gold rules unquestioned. In 2022, central banks' gold purchases topped 1,000 tons for the first time since records began, buying a total sum of 1,082 tons of gold. Then, in 2023, central banks purchased a further 1,037 tons of gold. And then in 2024, central banks broke their 22 record, buying a whopping 1,180 tons of gold at a cost of more than $100 billion. And I just want to remind you here, before 2022, central banks had never purchased more than 1,000 tons of gold. The closest they ever came was in 1962 during the Cuban Missile Crisis, when central banks purchased a grand total of 750 tons of gold. And yet we've had 3 consecutive years now where we've seen central bank gold purchases exceed 1,000 tons, with little sign that they'll be slowing down anytime soon. Yet I'm sure the critics will argue that this is some kind of aberration or some anomaly that we should all just ignore. The biggest buyers? Poland purchased nearly 90 tons to add to its reserves last year. Turkey managed 75 tons. We saw India buy more than 72 tons of gold, and China add 44 tons to its already impressive reserves. Finishing off the top 10 were the Czech Republic, Iraq, Hungary, Uzbekistan, Ghana, and Qatar. Gold is a tangible asset outside the control of any single country. It can't be sanctioned or frozen or inflated away if it's stored at home. In fact, supporting this trend, we've been seeing many countries all across the world, from Germany and Australia to India and Turkey, repatriate their gold reserves. Germany specifically has repatriated more than half of its gold reserves so far, and recent trade war talks has left German officials wondering whether they should repatriate all 1,236 tons of gold that's still stored in the United States Federal Reserve. Why? Because gold is the ultimate hedge against fiat currency risk and geopolitical distrust. Are you worried? Good. You should be worried. I'm worried. I've got no idea what you'll make of this, but I've actually purchased no stocks for over a year now because stocks are kind of really expensive right now. Just how expensive? Well, investors like to use the Shiller PE ratio, which looks at the prices of stocks in the S&P 500 and divides these prices by the 10-year average earnings of S&P 500 companies. Sounds good? Cool. Well, here's the problem with the Shiller PE ratio. In late 2024, the Shiller PE ratio reached 38. And I know that some people, I like to call them S&P 500 maximalists, will tell you to keep buying stocks with some of the money that you make each month and dollar cost average your way up. But, you know, there's a problem with that. It's bad advice that won't lead you anywhere but down. I've got a ton of data that shows that a Shiller PE ratio of 38 is high. It is really high. So high, you should be running away. Historically, whenever the Shiller P/E ratio has climbed over 30, the average of the next 10 years of stock market returns was a big fat zero. This means that if you choose to invest in today's overvalued stock market, you run the risk of making zero returns in the next 10 years. You might as well put the cash out of the stock market and put it under your bed because it won't grow, and to be perfectly honest, at 38 you might even make negative returns over the next 10 years. This is because, very simply, a really high PE ratio is just unsustainable and the market becomes due in for a correction. You can see this from this chart right here. The Shiller PE ratio reached a record, or a historic high back then, of 31 right before the Great Depression. Brought the stock market and the economy to their knees. By 1937, the economy had somewhat recovered, and the Shiller PE ratio spiked back up to 22 right before it came crashing down as a result of the 1937-1938 recession. The 1970s was arguably one of the worst decades for the US stock market. Most stock market investors made practically no returns in the 1970s. You probably already knew this, but what no one really seems to talk about is what immediately preceded this. What immediately preceded the stock market slump of the 1970s was the Shiller PE ratio spiking up to 23 in the late 1960s. And I doubt I need to remind anyone that the Shiller PE ratio reached an all-time high of 42 right before the dot-com bubble burst in the year 2000. I can go on and on and on, but I just won't, because I hope my point is clear by now. Investing in the stock market at today's prices is risky. You may lose money. Infinite growth is a pipe dream, and anyone who tells you to dollar cost average and not think too hard about it doesn't really know what they're talking about. If you care about your investment returns, stock market valuations matter. I have no data to back this up, unfortunately, but I'm pretty sure that at least some of gold's tremendous price appreciation over the last couple of years has been the result of some very wise investors choosing to park their money in gold rather than in stocks. Knowing how overvalued and risky the current stock market is at its Shiller PE ratio of 35 as of May 4th, 2025, when this video was made. So, I guess the question is, what do you do when the stock market is overvalued? You do what all wise investors do. You don't listen to all those other YouTubers. Don't dollar cost average. Instead, bide your time and exercise some patience. I know it's hard, but do it. And in the meantime, parking your money in gold can help you sleep better at night. And nowadays, you can even get creative with that hedge. I mentioned Strategy Shares GOLY ETF earlier, which is what we call a hedged bond ETF. The ETF holds a portfolio of investment-grade corporate bonds and adds a gold overlay to hedge the risks of monetary debasement and protect you from geopolitical risks, the looming threat of de-dollarization and runaway inflation. Funnily enough, both bonds and gold tend to do really well if stocks crash or if inflation spikes. So there's a possibility that you may stand to benefit twice over in the case of future economic turbulence, the risks of which seem to be growing day by day. And if I'm proven wrong, and we all live happily ever after for the rest of eternity, then that's okay too, because you can still collect the interest from GOLY's corporate bonds and enjoy any price appreciation that gold experiences in the meantime. It's really a very neat arrangement once you get the time to think about it. I think the reason GOLY has managed to fly under most investors' radar is because the average investor doesn't really get it. But that's not because it's a bad investment per se, rather I'd argue it's because people don't really understand it. GOLY is kind of both a gold ETF, but also it's obviously a bond ETF, depending on how you look at it, so that confuses people. It's an excellent alternative to bonds if you're a bond investor, because it hedges against monetary debasement, geopolitical risks, and inflationary risks that we spent the last 20 minutes talking about. But at the same time, if you're someone who wants to increase their exposure to gold, GOLY can be a really good gold alternative because it yields you an interest income. And I think that's really important. GOLY provides a 5% annual distribution which is paid out monthly to investors. And that's great news if you're heading towards retirement or need your investments to yield an income for you for whatever reason, since you'll no longer necessarily need to worry about selling your gold assets bit by bit to finance your retirement or receive an income from it. With GOLY, you get a gold hedge, allowing you to keep your gold exposure all while getting that sweet yield, which you can use as an income. Check it out if you want to. This video was sponsored by Strategy Shares. GOLY ETF is distributed by Foresight Fund Services, a FINRA member. You should find a link to the fund prospectus in the description to this video. Make sure you read the risks that are mentioned in the prospectus. Remember that this video is purely educational and is not investment advice. Past performance is not indicative of future results. Please do your own research and consult with a licensed financial advisor. There should be links in the description to help you find all the info that you need about GOLY. In the description, you'll also find a link that will take you to a few investing resources that are all free to download and use that I've created especially for you. Let me know your thoughts in the comments. I look forward to hearing them and see you all in the next video. In the meantime, don't let the gold bugs bite.